Most people think you need an investment loan to buy a rental property. They have higher rates, bigger down payment. That's what I thought too, but I'm happy to admit I was completely wrong. There's at least 5 totally different ways to buy rentals, and most investors only know about 1 or 2 of them. Today, I'll walk you through all 5 strategies, when to use each one, who they work for, and how to structure them. The last one is an absolute game changer. I'm going to start with the one that saved me from overpaying on 3 properties. The first one is conventional mortgages. Did you know that you can buy rental properties with conventional mortgages? Several years ago, I went through a 1031 exchange. I sold one investment property, it was a short-term vacation rental, and I took the equity that I made from that property to buy 3 more. Well, with a 1031 exchange, instead of paying taxes on the gain of that property or the equity you made, you actually get to roll that over into the next property or properties that you buy. It's a strategy I'll break down in another video. But I thought in order to buy these next 3 properties, I would need to get 3 separate loans, 3 separate investment loans. That's what I had typically heard. Now, investment loans typically have higher interest rates, higher closing costs, and that's what I thought I had to do. But I started doing some research and I came across a guy on YouTube, go figure, and he was talking about buying investment properties with conventional loans. Well, I'm a pretty skeptical person, and at the time, I didn't think this was possible. So I decided to call my credit union to see if they did this. I'd never heard of it. To my surprise, the loan officer actually said, yes, we do. And here's what he explained. Fannie Mae backs conventional mortgages for individuals, just like you and I would get a home loan. But they actually allow you to get up to 10 of those conventional mortgages per borrower. Not 1, but 10. And you don't have to use them on single family homes. You can also buy 2 units, like a duplex, a triplex, up to a 4 unit for an investment property. Now, these are not investment loans with higher rates. These are the same loans regular home buyers use. Same lower interest rates, same lower closing costs. So I actually saved thousands on these 3 properties because the interest rates were almost 2 full percentage points lower. And the closing costs, like I mentioned, were much cheaper because I was going through at a credit union. Now, in order to qualify, the bank doesn't only look at your income, they actually look at the income that you're going to be generating from the rent of this property as well. So how it works is you typically put down a down payment. Most of them require around 20%. The property doesn't have to be perfect. It just has to be financeable, something that you can use as a rental, and then you can buy it. This can change the game for a lot of you, and I really hope that it does. Okay, next we're going to talk about DSCR loans. It's really, really hard to qualify for loans if you're self-employed, if you get paid through a 1099, or if you don't have a W-2. Have you ever felt this frustration? You're doing everything right, or you're self-employed, you're building something real, but every time you try to qualify for financing, you get penalized for being smart with your taxes. You do what your CPA says, you take the deductions, you take the write-offs that you're supposed to, you run your income through an LLC, and then the bank says, I'm sorry, you don't qualify it for a loan because you don't make enough. It's so frustrating. And that's why DSCRs are great, because they work for everyone. You don't have to have a W-2. You don't have to have a 1099. They look at the deal and the cash flow of the property. DSCR is short for debt service coverage ratio, and it's a ratio. You calculate it by taking the rent of the property and dividing it by PITI, and that gives you a ratio. DSCR lenders look at the rent of the property that they bring in versus the mortgage payment. They want to make sure that you're bringing in enough or more than enough to cover that cost. DSCR lenders generally like to see a ratio of around 1.1 to 1.25, but they really do set their own parameters. Essentially, what they do is look to make sure that they're covering the expenses and you have a little bit left over if anything were to go wrong. That's what makes them so nice. You don't need a W-2. You don't need to show your tax returns. You don't need to show bank statements. If the property pays for itself, you're approved. With DSCR loans, your income doesn't disqualify you, the deal qualifies you, and that's how investors think. Number 3, seller finance. A few years ago, I got a call from a landlord. His name was Ishmael. I do a lot of advertising for motivated sellers here in Michigan, which is how he got my name. He was an older gentleman, and he and his wife, Deborah, own 2 rental properties in a really good neighborhood where I do a ton of investing. He said, Amy, I'm tired. I've been doing this for 30 years. I'm sick of late night phone calls. I'm sick of dealing with broken toilets. I'm just tired of managing tenants. But he's like, you know what? I know I'm going to get killed on capital gains taxes when I sell, so I only want to sell one property now. I get it. No one wants to write a check to the IRS when you sell a property. I totally understood where he was coming from. So I said, what if I could defer your capital gains? What if you could keep earning money monthly, but didn't have to deal with the properties anymore or manage them? He's really old school, and he was very skeptical at first. And that's when I proposed seller financing. So you can use seller financing when the property is held free and clear or there's no lien on it. You make monthly payments to the seller as if they were the bank, but the terms are completely negotiable. It's called an installment sale for tax purposes, and that's what allows them to defer the capital gains. They only pay capital gains on the amount of money that they actually receive. So those monthly payments or down payment, they don't have to pay it on the entire purchase at once. And it's a huge benefit to sellers. Think about this too. Have you ever wondered who owns all the properties that you want to buy? Well, a lot of them are owned by landlords, and those landlords are tired. They bought these properties 10, 15, 20, 30, 40 years ago. The mortgages are usually small or they're paid off completely, and the property's cash flowing. But the owners are exhausted. They're getting older. They don't want to deal with tenants. They don't want to have to deal with the management of the property. But here's the problem they face. If they sell traditionally, they have to pay capital gains tax on all that appreciation from the time they bought it to when they sell it. And that's a big chunk of money. Depending on how long they've owned it, that could be a huge tax bill. So they feel stuck. They feel like they can't afford to sell without paying half of their legacy to the IRS. But what if you could solve that problem for them and buy the property in the process? Next, we're going to talk about subject to. Did you know you can buy a property by taking over the mortgage payments while the existing mortgage stays in place? It's where you buy the property subject to the existing mortgage. That's where the term comes from. The deed transfers to you, but the loan stays in the seller's name. You just start making the payments. Now, you may end up giving the seller some kind of a down payment. It's all negotiable, but it's completely legal, and a lot of investors are doing it. So as an example, have you ever looked at a property and thought, if only I could get their interest rate? Maybe they locked in at 3% a few years ago. Their payment is so low and that property would cash flow like crazy. If only you could step into their shoes. Well, what if you could? What if instead of going to a bank today and getting a new loan at today's rates, you could just take over their monthly payment? Would that change which properties you could afford to buy? Absolutely it would. It's called subject to. Now you're probably thinking, who the heck would go for this? I know I thought that immediately when I started looking into it, but there are situations where it makes sense. The seller could be in a situation where they need to sell quickly. Maybe they can't sell traditionally. If they're upside down on the property, if they bought at the peak of the market and now the value's dropped, if they were to sell traditionally, they'd have to come to closing with a check to cover commissions and closing costs. Or maybe they're facing foreclosure. They're behind on their payments, going through a divorce, or relocating for work. You just never know what their situation can be. Maybe they don't care about getting a check at closing or a big check at closing. They just don't want a foreclosure on their record. It happens all the time. This is where you can step in and take over the payments. The mortgage stays in their name, but the property transfers to yours. You make sure the payment gets made every month, you protect their credit that way, and you get to buy a property without qualifying for a new loan. Now, this is an advanced strategy. You need the proper paperwork in place. You either need a transaction coordinator that is familiar with these transactions or a closing attorney. But it's real, it's legal, and investors are using it every day. Next, we're going to talk about that game changer strategy I mentioned to you. It's called a hybrid, and it's essentially a combination of seller finance and subject to. Let me explain. What if you found the perfect property and the seller is even willing to let you take over the mortgage subject to, but they have a lot of equity in the house and they don't want to walk away from it, and you don't have the money to pay for it all up front? You can't just take over the mortgage subject to because they need to get paid on that equity. But you also don't want to go to a bank and get a new loan because of today's interest rates. So what do? Well, what if you could do both? What if you could take over the existing low interest rate loan and structure a seller finance note for the remaining piece of the equity that makes up the difference between the sales price? This is what we call a hybrid deal, when you're combining seller finance with a subject to. Let me give you an example. 2 summers ago, we had a seller come to us. Her name was Heather. She had just gotten married, and her new husband just took a job down in Florida, and they needed to move quickly. In her mind, they didn't have time to put it on the market. Even though it was in really good shape and it may have sold quickly, they just didn't want to deal with it. It was probably worth around 190 to 195, and she had 150K left on her mortgage. She was willing to let us take over her mortgage subject to, which was amazing because it had like a 3% interest rate. But she didn't want to walk away from her equity, and I don't blame her. So we structured a deal where we took over her mortgage subject to her 3% mortgage for that 150K, and then we made up the difference in a seller finance note. We structured the seller finance note with such a low interest rate that we were actually able to give her a little more than what her property was worth. So her property was probably worth around 190 to 195. And in total, we were able to give her 200. So we did the first piece of the transaction, taking over the mortgage of the 150K subject to, and then we gave her a 50K seller finance note at a small interest rate. We were getting such an amazing deal. It didn't matter that we were overpaying a little bit for the property. In the end, it was much better for her. She didn't have to pay commissions or closing costs, and she was able to get more technically than what her house was worth at the time. It was a win-win. That's the beauty of real estate investing. You're solving problems, but you're in control of the structure, and you are building wealth without needing to go to a bank and have them tell you yes. You just need the right tool for the right situation. That's how professionals think, and that's how you win. If you found this video useful, you can download a free guide with all the details below.